evening, wherever you are. Welcome to the 2024 results call for MCB Bank Limited. Once again, we're very pleased to have the Chief Financial Officer of the bank, Mr. Hamad Khalid, join us for today's call. The format of the call will be a brief management presentation followed by a question and answer session. Before we begin, a few housekeeping rules. During the presentation, all of the audience will be on listen-only mode. If you have a question to ask, you can raise your hand and we will prompt you to unmute yourself and ask your question, or you can type in your question in the chat box and we will read them out to Hamad. With that, Hamad, over to you.
Thank you, Raza. Bismillahirrahmanirrahim. Good day, everyone. Thank you for joining in the result release call covering the key financial performance indicators for the year ended December 31st, 2024. So again, I'll start off with a snapshot of the operational and financial landscape of MCB Bank Limited conventional side. So on the branches side, we are operating 1,395 branches on the domestic front, thereby containing the growth on the brick and mortar side at the conventional front. From the international perspective, we have added one wholesale banking branch in Sharjah and one representative office in UK to facilitate trade and remittance transfers, taking our total tally to 8 as far as international branch network is concerned and one representative office. We are proudly serving a customer base of over 9 million through our brick and mortar and digital channels. As far as our market share is concerned, we hold 5.74% of the domestic industry deposits as of December 31st, whereas based on the performance on the advances side, our share has improved to 6.46 on the domestic advances front. Home remittances remains a key strategic focus areas as we have channeled close to $4.6 billion in the year 2024 through MCB's network, scaling up our share to 13.20% as of December 31st, 2024. Now, a snapshot of our digital transformation. So if we start off with MCB Life, this was relaunched in the year 2021, tail end December 2021. And within first year of operation, we were able to scale up our registered user base from a meager 100,000 customers approximately on the legacy platform to 714,000 customers. As we speak, we have almost doubled our registered user base to 1.4 trillion with financial active customers who have conducted a financial transaction on the digital app, averaging around 40%. As far as the throughput is concerned, it is almost 3.5 times, 486 billion in 2022 to 1.752 trillion in 2024. So this highlights that there is a gradual slow shift towards the digital front in terms of value. Obviously, transaction count is more on the digital front, but when we map it with the OTC volumes, it is on an increasing trend. Corresponding to the retail and all-encompassing growth outlook, our debit card spend, POS acquiring spend, e-commerce spend have almost doubled over the course of last 2 years. So the theme here is personalization. We are actively reviewing the spend patterns of our customers, devising value proposition, adding alliances in our campaigns through our campaigns. Lastly, ATM acquiring, the forum would recollect that we have, I believe, a couple of years back, replaced the entire fleet with new machines. And as we were viewing this as a business opportunity. So acquiring transaction means a customer of other bank using MCB's ATM fleet to withdraw money. Obviously, this has a business case back to it. Apart from that, we are constantly adding services to our ATM menu, thereby moving or aligning ourselves, moving our customers out of the brick and mortar branch channels and towards the ADCs. Now, coming back to the macroeconomics, so 2024, from a global perspective, has been an eventful year, with Pakistan being no exception. So the country has navigated through a host of challenges thrown at it, starting off with the hosting of general elections in the first 2 months of 2024, the results of which draw some political noise, which to an extent have subsided. The tapering of high costs, a high inflationary environment, good agriculture produce gains, signing up of IMF extended fund facility with a very well-defined structural reform agenda, debt sustainability challenge, and last but not the least, the emerging law and order crisis, specifically in the area surrounding our porous borders. However, having said that, the country continues to solidify its position against all these challenges while complying with the covenants that we have signed up with the international lender. The softening of inflation from 28.8% last year to 7.2 in the first half of fiscal year 2025 provided the much needed room for monetary easing cycle to start, with the Central Bank of Pakistan slashing the rate by 1,000 BBS till January 2025. We are of the considered view that this particular cycle has bottomed out. Maybe another 100 basis point is what we might see in March. However, the considered view is that it's a bottom. We might not see that change in the upcoming monetary policy. From the external and fiscal front, we believe that the challenges that we face are going to keep us on our toes in the times to come. From the revenue side, I believe the dependence of the fiscal dependence of the system on banking companies is expected to continue in the foreseeable future, as was evident by the ordinance that was promulgated on 28th of December 2024, where the corporate tax rate for the banking companies was revised upward by 5% for the calendar year 2024. Now, from MCB's perspective, considering that the guidance that we gave to the market was we were all set to achieve the 50% ADR benchmark, there was a phenomenal growth in advances base of 476 billion rupees, taking our base to 1.1 trillion approximately. We continued with our strategy to build no-cost deposit base, as we have added around 82 billion worth of current accounts in our average base. On the operational front, we remain one of the most efficient bank in the industry with a cost-to-income ratio of 32.68. Standalone profitability of MCB Bank was reported 118.4 billion, reflecting a drop of 5%, whereas consolidated PBT of the group was reported at 131.2 billion rupees, reflecting a drop of 4.6%. Now, moving on to the numbers, starting off with a statement of financial position, the total asset base standalone basis of 2.7 trillion reflects an increase of 276 billion rupees. This time around, on the asset mix side, the growth was led by advances. Gross advances 1.1 trillion, reflecting a growth of 472 billion rupees. The heavy lifting on this front was done by the corporate segment, which reflected a growth of 465 billion, primarily the short-term financing side, followed by increase in overseas segment of 19 billion rupees. On the investment front, 1.1 trillion versus 1.249, a drop of 82 billion rupees. So on the floating rate VIBs, we added 92.4 billion. Fixed rate VIBs, a net addition of 36.7 billion. The reason why I say net is it is net of the huge majority of 80 billion rupees that was due in the third quarter of 2024. Treasuries decreased by 278 billion rupees, closed at a base of 76 billion. Yield and investment have 18.60 as compared to 18.37 for the last year. On the liability side, deposits, we reported a base of 1.922 trillion, reflecting a growth of 117 billion rupees in absolute term. Current account increase of 73 billion, taking our base to 944. Saving account increase of 47.88 billion, taking our base to 925 billion rupees. On the equity front, a base of 227, reflecting a 10% growth, 20.59 in absolute terms. Now, moving on to our advances, obviously, as I said earlier, corporate took the lead, 903 billion base versus 438 billion increase of 465 billion rupees. Retail, which comprises of small and mid-sized companies, reflected a drop of 11.6 billion. Consumer, on the other hand, on strategic note, we have been guiding this to the market that we were focusing to contain the losses considering the high interest rate environment. However, considering where we are, we believe there is some growth potential on the consumer segment for the year 2025. Overseas, 60 billion versus 41 billion, increase of 47%. This takes our MCB domestic advances base to 1.034 trillion, a growth of 453 billion, resultantly our market share improving by a decent 180 odd basis points approximately. On the NPL side, in accordance with the guidance that we gave earlier, no shocks there. We reduced our base by 331 million rupees on account of the splendid performance done by a recovery team. As you would observe in the loss categorized loans, there is a drop of 2.3 billion. There was some addition in the doubtful category, primarily on account of objective and subjective downgrades. 1.9 billion is the addition in doubtful categories. This is not sector-specific, party-specific, where fundamental characteristics of the borrowers reflect some weakening, and we subjectively or objectively downgraded those exposures. Based on the increase of 1.1 trillion or a base of 1.1 trillion for the year 2024, the CAGR improves to 12.26. Yield on advances drops from 17.89% for the year 23 to 16.87, reflective of the massive monetary easing cycle that we witnessed during the year 24. As an update on NIB-related recovery, we have recovered another 921 million rupees in the year 24, taking our total recovery to 10.6 billion over a period of, say, approximately 7 years since this was merged with MCB back in July 2017. Sums up to a recovery of around 35-36%. And hopefully, in the times to come, we will be driving more value out of this NPL base. On the investment front, treasury bill, a base of 76 billion, reflects a drop of 278 billion. Fixed rate PIBs of 250, floating rate PIBs of 687 billion rupees. So the PIB concentration is around 81%, improved from 63 that we reported last year, whereas treasury bills drop in concentration from 28 to 7%. Another major component where we added was shares in listed and unlisted securities, 39.34 versus 31 billion, an addition of 27%, 8.3 in absolute terms. Major exposures were in oil and gas, bank and cement industry. The stakes are investment and cost to 1.1 trillion versus 1.284 trillion rupees. Since this was the first year where IFRS 9 was applied and the entire equity investment of the bank was classified as FVOCI, so the related provision was reversed and a corresponding increase in deficit was recorded in the opening balances. However, based on the performance observed at the capital market bourse, the deficit that we reported last year of 23 billion is now a surplus of 15.7 billion rupees, much of it related to the equity portfolio to the tune of around 11 billion and the balance of 4 billion on our fixed and floating rate PIBs. On the deposit front, the growth in current account has outperformed the CAGR growth, and current accounts are outperformed the total deposit growth. So thereby improving our current account concentration around 49% in absolute term, and on average basis, I believe it would be around 47.5 to 48% for the bank. So a total deposit base of 1.9 trillion, current accounts of 944 billion. So we are striving hard to cross that 1 trillion benchmark, hopefully when you see the results for the first quarter of 2025. On the saving deposit side, based on a strategic approach, as we guided to the market that there is a negative carry on the saving accounts due to the inversion in the yield curve, we strategically focus on reducing our monthly payout products. There was an outflow from the banking industry to mutual funds and treasury bills and PIBs in particular. So our saving deposit was reported at 925 billion rupees. Pertinent to highlight that we don't have a single rupee of special rate on the saving local currency domestic deposits. Cost of deposits was at 9.23, up 59%, 59 BPS year on year, whereas CASA worked out at 97.24% for the year. Now moving on to the performance numbers, gross markup income 367 billion reflects an increase of 39 billion rupees. Markup expense 218, a negative variance of 37 billion. On the net markup income, almost flattish when mapped against last year, 149 versus 148 billion. So if I take you through the spread analysis, on the earning asset side, gross advances 663 billion at a yield of 16.87 reflects an increase of 46 billion rupees in average volume of advances, where there's a drop in yield on average of 102 basis points. So gross markup income advances was up by 1.451, primarily fueled by the volume variance to the tune of 8.2 billion rupees. On the investment front, a base of 1.3 trillion at a yield of 18.6 reflects an average increase of 215 billion, increase in spread of 23 basis points. So gross markup income investments was up by 42.46, primarily contributed by the volume variance to the tune of 39.5 and price variance contributing 3 billion. On the deposit front, 1.9 trillion average volume at a cost of 9.23, which is up year on year by 305 billion average, increase in cost of 59 basis points. So cost was up by around 38 billion rupees. So out of this 305 billion increase, almost 82 billion was in current accounts. Resultantly, the spread saw a compression from 7.11% for the year 23 to 6.22, a drop of 90 BPS. On the non-interest income side, a base of 37.43 versus 32.92, an increase of 13.7%. The prime contributors to this were fee, and the major revenues within the fee segment were cards, trade, and cash management services. Whereas there was some reported increase in dividend and capital gains. Non-interest income, on the non-markup expense side, 63.78 versus 55 billion reported for the last year period. So despite the inflationary pressures, we reported an increase of around 18%, thereby containing the increase to 18%, I would say. And the major heads where this increase was registered was compensation expense on account of the human merit cycle adjustment that was recorded for the year 2023 in the earlier part of 24. Along with that, the communication expense has some IT-related expense that contributed to this increase of 18%. Profit before credit allowances of 122 billion versus 125 billion, a drop of 2.9 billion. On the credit allowance side, 4.3 billion charge versus 6.37 billion charge recorded in the year 2023. So a negative variance of 4 billion. So the prime reason for this is this enormous increase in our credit portfolio. Stage 1 charge accounted for. Considering the volatility that we have been observing on the ECL model calculation, there was a policy approved by the board that we are going to maintain approximately 1% general provision charge for the funded exposure of stage 1 and 5% for stage 2. So as a result of that, there was a general reserve of 4.7 billion created for the year 2024. This takes our profit before tax to 118 billion rupees versus 125 billion rupees reported for the last year, a drop of 5%, 6.8 billion in absolute terms. As I covered earlier in the presentation, prior to the year end, there was an ordinance promulgated where the corporate tax rate for the banking companies was revised upward by 5%, taking it to 44%, plus the 10% super tax and effective tax rate of 54%. However, the ADR-based penal taxation regime was abolished, as a result of which the bank was able to reverse the provision that it was maintaining for the calendar year 2021, tax year 2022. So a net charge of approximately 2.5 billion reflected in the profit and loss statement. That takes our profit after tax to 57.6 billion, a drop of 2 billion rupees when mapped against last year. On the capital ratio side, Tier 1 of 15.5, Tier 2 of 3.9, CAR of 19.35, so significant buffer on top of the regulatory requirement of 785 basis points. As far as the leverage ratio is concerned, it's at 6.37 versus the regulatory requirement of 3%, liquidity coverage of 241, and net stable funding ratio of 120 against the regulatory requirement of 100%. Now, snapshot of our MCB Islamic profitability and statement of financial position. So, based on the pressures coming in from ADR, the deposits reflect a muted growth of 4.65 billion versus last year. However, advances reflect a decent growth of 32 billion rupees, translating to 35% growth. On the performance side, you would observe a drop in their profit before tax number from 10.57 billion to 9.11 billion, drop of 1.5 billion. This is primarily on account of the increased operating expenses as the franchise has been growing its network. As you look at the graph on the right side, below graph, the number of branches as of December 31st, 2024 have scaled up from 224 to 301. This includes the transfer of 39 branches, the demerger and merger exercise that was concluded in November 2024. So going ahead, the strategy on this front is that we'll be scaling up our Islamic banking franchise, containing or reducing our conventional banking footprint, and complying with the regulatory requirements which are in place. So this sums up the presentation from my side. Over to you, Raza, for the Q&A. Thank you.
Thank you, Ahmad, for that comprehensive presentation. Once again, ladies and gentlemen, if you have questions to ask, you can raise your hand and you can ask Ahmad directly. Or if you want to type in your questions, you can do so in the chat box and we'll read them out to Ahmad. Ahmad, we don't have raised hands at the moment, but we do have questions in the chat box. The first question, well, there's a bunch of questions. I will read them out one by one, and then you can take it from there. The first question is from Waleed Rathor, and So the first question he's asking is, what growth does the bank expect to achieve for advances and deposits in calendar year 25? And is there an ADR target? If so, what is it?
Well, since there is no regulatory target in place now and the pressures on the ADR side receding, I believe the balance sheet is all set to change its course in the next quarter or so. And this is for the entire industry, not specific to MCB. So I believe the advances side, we expect to report a drop in the total base. 1.1 trillion is what we have reported. I believe the normalized number would range between maybe around 700 to 750 odd billion rupees. On the advances front, the focus is entirely on the current account side. As we have been sharing earlier, that there has been a serious amount of negative carry, which stands at risk as we speak, but the focus entirely is on the current account side, and we expect to cross the 1 trillion benchmark that we have set for ourselves in the first quarter, inshallah. So the target that we are eyeing to achieve is close to a 15 and 18% growth on the deposit side, but it would be, I believe, heavily tilted towards the current account accumulation.
Understood. The second question from Waleed is, has the deposit increased to normal levels since the close of the year? Um, I think he's asking about the deposit base. Yeah.
Yes, obviously, I can't share numbers since these numbers are not public as of now, but we have achieved the normal deposit number, but the tilt or the shift is towards current account. So it's not the similar mix that you observe in the balance sheet as of December 31st.
Understood. And there are three questions. I'm going to club them together. These are also from Waleed. So he's asking about investments. The yield on the fixed PIB investment, any maturities or repricing that can be expected during the ongoing quarter, and is there an optimal investment mix that you're targeting for 25?
Well, considering where the interest rates are, Vineet, at the moment, I believe the mix is what you have seen in the numbers. We don't expect a drastic or a major shift in the concentration levels of floaters and fixed rate PIBs in this particular quarter. There are no major maturities which are coming our way in the first quarter. As far as the average yield is concerned, I don't have the absolute number, but I believe it would range somewhere around 14.5 to 14.8% for the fixed rate PIBs. And the weighted average maturity for the fixed rate PIBs would be close to 2.7 years.
Understood. Waleed, I hope that answers your question. We have a question from Saklen from ARN Financials. And your Islamic branches went from 224 to more than 324. So he's asking if you can provide some guidance for how many more branches you expect to open in 2025, Islamic versus conventional.
Well, on the conventional side, as I covered, we don't expect to expand our footprint. There has been this particular last year has been a year of consolidation. We started the year at 1,437, if I recollect, but we closed the year at 1,395 domestic branches. So obviously, the transfer of 39 branches from the conventional side to Islamic took place in the fourth quarter of 2024. So going forward, the strategy is that we are going to contain our conventional increase, brick and mortar, and on the Islamic front, we will be increasing our footprint. I believe the shorter term target that we have inside is we should be running a mid-sized Islamic bank operating 500 branches. So for that, we have set a target of 3 years from now. So almost 200 more branches is what we eye over the course of next 3 years on the Islamic side.
Understood. The next question is from Syed Murtaza in the chat box. And I think you might have answered this, but it might be convenient if you share this again. So he's asking the average yield on fixed PIBs and floating PIBs, if it's possible for you to answer.
Well, on the fixed rate, as I covered, it's around 14.5 to 14.7. Fixed rate, obviously, it's a function. It's obviously changing based on the maturity profiling of the contracted repricing based on a specific tenure bond. So what I can say is that it would be close to 13.1 to 13.2 based on the current yields.
Thank you. The next question is from Syed Fawad Basir, and he's saying market chatter has suggested a change in compensation structure on retail level across the sector. Does this impact MCB as well? Because we believe 2025 will be a race for current accounts.
Yeah. Absolutely. As I said earlier, obviously this is a dynamic process. So every other bank is looking at it from a different perspective. From MCB's perspective, what I can share is yes, there are multiple things that are in play as we speak. This does involve looking at how we categorize branches into different segments. Obviously, categorization of branches involves maybe some perks or some upgraded cost tag to it. Secondly, there are some incentive campaigns that are in play. Thirdly, the KPIs that you mark to the field formations for delivery for the year 2025. So all I believe is aligned to generate the growth on the current account side, and that is why I'm saying with confidence that we anticipate that this would be a different year. You would see the concentration level of current accounts improving from where we have reported as of year, and we reported 49%. The short-term target for us is 55. Although we are not saying no to those saving accounts, obviously we are here to serve our customer base, and we will continue to do so. But the strategic focus is current accounts, is the impact on the asset side or the yield side has been more pronounced if we map ourselves with last year's same period.
Thank you. The next question is a follow-up from Saklen. And he's asking if you can share the impact of removal of the minimum deposit rate on NII, specifically the expected cost of deposit in 25. And I think there's been two things, right? I mean, for the Islamic side, there's been an
There's an
introduction, and
imposition,
for the
yeah, that's
conventional,
fine.
there's some relief. So maybe the combined sort of.
Well, for the conventional side, I can speak on behalf of MCB. So the three particular categories that were removed from a MDR application on the conventional side were public sector exposure, financial institution, and public limited companies. So looking at MCB's franchise in particular, we have a very small deposit base which is tagged to these three categories. Primarily, we are a retail bank and focusing more on individual deposits, and that's the split that we have been carrying, and that would continue to be our focus area in the times to come. So if we work it out for MCB, it would be less than, I would say 100 billion, less than 5% of our total saving deposits. And for that, any change on the MDR side is not going to impact the net interest margins by much. So, and even if you look at the rates that have been published by the pair banks for this saving deposits after this MDR removal, it's not much different from what we have on the MDR front. Maybe few selected banks have opted to continue with the MDR. So for MCB, currently we are offering 9% as the rack rate for these three categories. Obviously, it depends on the relationship. If we find value in a particular relationship, and if we look at it from a 360, maybe generating some fee income from or other income from other revenues, we might actually offer a better rate to those customers. But it cannot exceed the minimum deposit rate by any means. So factoring that into the equation, I believe we don't expect much of an impact on the net interest margin side on this front. On the Islamic front, I would say that the imposition of MDR, it's going to impact their performance numbers in the time to come. Obviously, depending upon a model, depending upon different concentration level that a specific Islamic entity holds. But for MCB Islamic, the impact that we have worked out for this MDR application would be around approximately 2 billion rupees.
Thank you, Ahmad, for the detailed answer. Follow-up question from Syed Murtaza, and he's saying fee and commission income declined QOQ. Can you please provide guidance on this?
Well, I believe we touched upon this in the last meeting as well. One of the major factors that is impacting this is the remittance flow. So the competition on this particular revenue has intensified over the course of last few months, and obviously it has relevance to the FX liquidity that a particular bank has. So on a strategy note, what we are trying to do is ensure that more and more remittance is channeled through MCBs. And for that, you have to pass on the rebate that we were earning earlier. So obviously with the counterparties, a generic revenue sharing model was around 75-25, which approximately as of now has gone down to now 95 or 5%, 5% favoring the bank and 95% for the counterparties to channel more remittances here. So that's one particular revenue which is reflected in the fee income in the previous years, which is not there. Apart from that, as I shared earlier, there are other revenues which are generating good, decent traction. And we expect that in the times to come, we will be reporting a decent growth on the fee side.
Thanks. Hamad, if I may jump in here with a follow-up question, and I know you talked about remittances right now, and I think the presentation, you mentioned a 13.2% market share within remittances. Just wanted to know, I mean, obviously, we've now seen, or we will see the advent of digital banks in Pakistan. Licenses have been given, they are becoming operational. Do you think this is they can provide meaningful competition, maybe on remittances? I suppose it's early to say, but what about remittances? Because some of these bring that they are, based in the Middle East. So what do you have to say about that?
Well, Raza, we do expect some challenge on this particular front, particularly the remittance side of it. However, from an overall perspective, since this was in discussion for an extended period of time in the past, whatever is being offered to the digital banking or tagged with the digital banking license is what a conventional bank with a digital footprint can offer. So there is not much of a difference. So we opted for the digital transformation to take place rather than opting for a digital license in the country. So the challenges on the remittance fronts, in case they are able to structure something which can facilitate the beneficiary in no time, and structuring that app to app kind of a transfer, that might create some hurdles or some competition for the conventional banks. However, what I can assure you that the conventional banks are working on similar lines. So they are tying up with other app providers who are operating in particularly in Middle East and Saudi market to facilitate such transfers. And you will see that happening most probably in a quarter time or so for MCB as well, inshallah.
Understood. Thank you. The next question is from Mohammed Tahir, and he's asking, what is the bank's outlook on the cost to income ratio, considering the lower inflation in this year, in 2025?
Well, I believe our cost to income ratio would take a hit, but not very significantly. We expect it to dilute to maybe around 35%, 36% on a standalone basis. And that primarily on account of the revenue decrease, nothing very significant planned for the OPEX side for the year 2025. However, as we shared earlier, the effect of the drop in discount rate is more pronounced on the asset yield side. So if we are comparing two particular years where an average return of around 16, 17, 18% was generated versus a year where the average asset book is going to yield around 12.5 or 13% at max. So there would be some drop on the revenue side, and that impacts your cost to income ratio. So having said that, as I shared earlier, the strategy is to build up the current accounts. What I can safely tell you that whatever we have added in the year 2024 in current accounts in totality, we are trying to surpass that target in the first quarter, and that too by a decent margin, inshallah.
Thank you. The next question is from Mustafa Mustansir. In light of revocation of stay order on windfall tax by Sindh High Court, how likely is it that the stay order will be reversed by Lahore High Court? And what could be the potential impact on MCB in case the stay order is revoked by LHC?
Well, thank you, Mustansir, for the question. I believe the matter is sub judice as far as MCB is concerned. We have a valid stay. Same was the case with all the banks operating in Karachi in particular, but that stay got vacated last Thursday, and as a result of which there was a tax cash outflow of around 23 odd billion that was reported in the news yesterday and day before yesterday. So from the impact standpoint, the amount stands fully provided in the books of MCB back in 2023. It's just a matter of tax cash flow that, and I believe that was the case for the entire industry, barring a few exceptions. So no financial impact or no EPS impact in case a similar our petition finds a similar fate.
Thank you. And to be sure, I mean, MCB has booked the associated
Yes, we did
tax
that
on
in the
windfall.
calendar year 2023.
Okay. We have a question from Mohammed Abrar again. He's asking and I think you might have answered this, while you were doing your presentation, but he's asking the effective tax rate for CY24 is 51.6%, although the tax rate for the year should have been 44 plus 10, 54%. So are there any tax reversals? The
Well,
ADR.
as I said, when this ordinance was promulgated on December 20th, 2024, the ADR-based penal taxation regime was abolished. So the bank was carrying provision with reference to calendar year 2021, and I believe the entire industry was carrying that provision. You would recollect when this ADR was introduced in June 2022, there was a retrospective application for the last year. So it was challenged by the banks in courts. However, with this ordinance coming into play, that provision was no longer required. So that provision relating to year 2021 was reversed. The additional 5% corporate tax rate was incorporated in the fourth quarter financial. A net impact of say, approximately 2.5 billion tax incidents was recorded on account of these amendments.
Thank you. Follow-up question from Mustafa Mustansar. Could you please share any plans for IPO of MCB Islamic and any expected timelines for the same?
Well, I don't have a defined timeline for that, but obviously there is some planning which is underway as we speak. We do understand it's a big activity. We are waiting for the right moment to actually initiate that. But what I can just share with the market is that there is an active discussion on this particular point.
Thanks for that, Ahmad. As of this moment, we don't have any questions in the chat box. Ladies and gentlemen, if you have questions to ask, please raise your hand so that you can ask your question directly, or you can use the chat box to type in your questions. We've got a couple more questions from in the chat box, and I will read them out to you. The first question that we see is from Faisal Sultan. Hi, Hamad. Great results. Congratulations. Just want your thoughts on your entry in UK through a rep office. You alluded this is to capture the remittance market. Love to have your thoughts on how you see potential in Western Corridor vis-a-vis Middle East markets when there is a lot going on in the Arab region overall.
Well, thank you for the question, Faisal. So, what we have witnessed over the course of last few years that UK is developing into an active market from a remittance perspective. One of the major remittance partner for us, for MCB in particular, is a vendor or is a party based out of UK, and it has channel. I don't have the absolute number, but I believe it would be close to $1 billion for MCB Bank Limited. So that's where we want to focus on while we continue to put ourselves in UAE and Saudi markets. That's the major driver from a Pakistan perspective. However, we are in the process of exploring other markets as well, and that opening of a rep office in UK is pretty much linked to that move. So in case we are able to see the non-conventional corridors maybe helping us in channel more remittances flow to Pakistan, that provides us more leverage to generate more FX. Plus, obviously, as we have been saying, that's one of the key focus areas for MCB to convert the beneficiary accounts who take money out as cash to have deposit relationships with MCB Bank Limited. So that's a wholesome kind of a strategy which is in play. Obviously, the amount of money that we are passing on to our counterparties in the shape of rebate is one of the components. So if you look at it from a 360-degree perspective, it has the potential to operate a separate bank on its own. You can actually channel FX, you can have your deposit base, you can charge fee, you can cross-sell from this particular segment of remittance business. So in the times to come, we will see better results coming from this particular site. We are very much focused, as you know, that we are based out of Lahore, and this remains a key focus area as far as the province of Punjab is concerned. Approximately 70 to 80% of the total remittance flow for the country is based out of this particular area. We start off from maybe Gujranwala and we end up at Sohawar between Jhelum, and around 70% of the total flows are here. So that's where we want to capitalize. That's what we want to translate into business potential for MCB Bank. I've been saying that for a while now. I understand that we have done some decent work. The cash over counter transactions, which were almost 65% back in 2019, are now down to 11% based on the latest numbers. So we have converted them into our deposit relationships, and we are actively engaged to explore non-conventional markets, non-conventional corridors to channel more remittance through MCB channels.
Thank you. The next question is from Mohammed Bilal Ahmed from Dawood Investments. So this is a follow-up on, you said that there's a debate going on with respect to a potential IPO for MCB Islamic, and he's asking, what would your motivation be to reduce your stake in MCB Islamic back in the first place? Would it not expose MCB to additional dividend taxation, which may make the move inefficient, especially given that MCB already has very strong capital buffer?
Well, as I said earlier, there's an active discussion. I do understand there are some pros and cons attached to this particular transaction. You see, we need to understand that there is a federal Sharia court ruling in place. There is a push coming in from the regulator that the entire financial system of the country has to shift to Sharia mode. So I can't share specific details on this particular platform, but what I can say is that there are few options that are being evaluated in detail at the board and the management level. So you would see results in the near term. Obviously, the decision has to be taken and effectively communicated to all the stakeholders.
Got it. We have a question from Mohammed Ali, and he's asking Mohammed Ali from AKD Securities, and he's asking your outlook for interest rates and currency, the exchange rate for 2025.
Well, on the interest rate side, I believe the cycle has bottomed out. We don't expect much of a movement from here, though the market consensus based on the inflationary outlook for the month of Feb hints at 100 basis points slash maybe in the upcoming monetary policy. But we carry kind of a different view here. We believe there won't be much of a movement there. On the FX side, with the import bill rising month on month, uh, exports being stagnant, although remittance numbers are posing some challenge. But with Ramzan coming in, I believe there would be some traction on this particular front as well. But there is some pressure being exerted on the FX side. So I don't rule out the possibility of some movement, not very significant on the FX side, but it might be around 1% to 2% at max in the shorter term.
Thank you. Question from Mohammed Abrar. What is MCB's stance on leveraging? And I think they mean balance sheet leveraging, given that other banks have significantly profited in CY24 by using the OMO window, by borrowing heavily from the SVP, he says.
Well, you see, if there is an arbitrage to be done, we would actively engage into that. The thing that you are referring to was when you actually borrow at 21 or 22% and invest at around 15%, that's something that you take a call on how you expect the interest rates to actually move forward or shape up as you thread ahead. So for MCB, based on our defined risk appetite, we took an OMO of close to around 200 billion. This is what our appetite allowed, and we did a similar kind of a transaction, not in trillions, I can say, not a specific amount that we had in mind, but obviously, if an opportunity was there, we did invest into that, but not to the tune of what our peer banks have done in the year 2024. So going ahead, in case we find anything which offers us an arbitrage on borrowing and investing treasury bills and maybe gaining out of that, we will explore that option. But again, as I said earlier, remaining within the risk appetite that we have defined for ourselves. Nothing very extravagant.
Understood. Hamad, if I, at this point, may ask a couple of questions of my own. I think in the presentation, in your spread analysis, you showed that, spreads on margins were 7.1% in 23, came down to 6.2% in 24. And assuming interest rates stay where they are, would it be possible for you to give some broad brush guidance on margins or spreads for 25? And
Well,
secondly, sorry, go ahead, and then maybe I can ask my second question.
Well, Rosa, we do expect some compression to reflect on the NIMs for the year 2025. But the strategy is, as I covered earlier in detail, that we are focusing on generating more and more current accounts and working on a cost to income ratio of around 30% in case we are able to solicit more deposits by incentivizing our staff. That's the strategy that we intend to follow for the full year. And we are hopeful that we will see some decent traction that would maybe to an extent cover the NIM compression that we anticipate for the year 2025, or maybe outperform the NIM compression and maybe have a better number than what we have reported for the year 2024.
And so the follow-up is actually on your current accounts. I mean, and they've grown to 49%. Any target in mind for 25? And for banks, is there a theoretical ceiling on current accounts? I mean, obviously you have to look at the duration of the asset book also, or is it that, as much current accounts, the better? Or is there a point where you think that, okay, we can only increase it to this much and that's it?
There's no defined ceiling per se, Raza. We can actually scale it up to any level. But the benchmark that we are following, or the concentration that we are following for the shorter term, is around 55%. So of the total deposit base.
Understood. Hamad, at this point, there aren't any questions, there aren't any raised hands or any further questions in the chat box. So given that we're 45 minutes past the start mark, maybe you can make a few closing remarks.
So, first of all, thank you everyone for your continued interest in MCB Bank Limited. So, in the times to come, what we intend to do is focus on our strength being low or no cost deposit mobilization, an efficient expense base, controlled NPLs, no concerns on the asset quality. But now a new thing coming into play is the digital transformation, which is going to aid our retail franchise as we thread ahead. So we are heavily invested in digital and IT-related infrastructure, have been doing so for the last many years now. And we expect that you would see the results of it in the performance numbers in the times to come. So this year it seems to be a challenging year, but we are all geared up, strategized everything. And as we speak, there are some decent numbers that we have piled up. Obviously, as I said earlier, I can't share it since these numbers are not public, but everything is lined up for a great year, inshallah, ahead.
Thank you, Hamad. Congratulations once again on a strong 2024 and best of luck for 2025. And
Thank you,
thank you,
Raza.
everybody, for joining us on the call.
Thank you, everyone. Thank you.